Actually, the previous recordings were not yet uploaded to the system. Within this week, I will arrange the things. Because these files are bulky, I need to either upload that into YouTube and give the link. I don't think that it would be possible to upload to LMS system. Within this week, we will finalize the mode of uploading the files for you. Half ratios aggregate to explain return on common equity. Here, you know the basic idea. Sometimes you may have already heard about very famous structure or tree structure, what we call DuPont analysis. DuPont analysis breaks the overall return into grassroots level to see how each and every asset or group of assets or strategic business units or a department or particular section has contributed towards the profitability. But under the DuPont analysis, we don't do any reformatting. We use the numbers as they are given in the financial statements. But here again, we use the same structure of DuPont analysis, that the tree structure ratios are broken down into different levels in such a manner that connects to each other up to certain level. So that is why we be aware that ROCE acronym in some textbooks, ROCE is used returned on capital employed, but here return on common equity, or otherwise we can use the acronym as ROE. ROE. I just took it as it was given in the recommended textbook, but for our understanding purposes, if you want, we can make it as ROE, return on equity. How economic factors determine ratios? So influence of economic factors and all those things will be discussed. Some of the things may not be able to quantify. Financial leverage. So this is little bit critical area where entities have lots of opportunities of using others' money for its own purposes. Simply speaking, this is the simple idea of borrowing. When you borrow, what would happen to your returns, your earnings? Under normal circumstances, we know that the basic idea of borrowing is not to waste that borrowed funds, but to utilize them in such a manner that would generate some return. So theoretical argument of borrowing is therefore it's always advantageable for the entity. Why? The corresponding cost of borrowing, or the borrowing cost, is relatively lower than the earning potential of those assets. Return on assets is greater than, under normal situations, greater than cost of borrowing. Entities have additional advantage of borrowing. The gross borrowing cost can be further reduced because interest payments are allowable, a tax allowable expense. As a result, your real cost of borrowing is relatively low. For instance, if you borrow at 10%, if you borrow as an individual assuming that there are no any other costs, annual interest rate is 10%. Therefore, it becomes the yield of the lender. So that's 10%, right? For individuals. But for companies, if companies borrow at the same rate, 10%, yes, gross cost of borrowing is 10%. Real borrowing cost is not 10%. It would be not, it will be less than 10, depending on the rate of the tax rate. If you assume that tax rate is 40%, that means you need not to pay 40% of that 10% as tax, because 10% interest is recognized or allowed as a deductible expense for income tax computation. Therefore, if you have paid 10 over 100, right, that 10 is an expense that has been already deducted. By that amount, your profit has gone down, so that you save something in terms of tax, which would have otherwise been paid. That's the argument. Actually, there is no direct inflow. This is an argument. So if there were no such borrowing, your tax payment would have been otherwise greater than this. So then how is it calculated is that amount multiplied by 1 minus tax. If the tax rate is 40%, 1 minus 40 means 0.6. It's 60%. Therefore, your real cost of borrowing is the 60% of the interest rate. Therefore, it becomes 6%. Is that clear to everyone? Is that clear to everyone?
A little bit confused. Can you repeat it again?
Mouse is also not working. Okay. It's like this. First, I'll show it. Do you see the screen now?
Yes, sir.
Let's make it a little bit big. Assume that two scenarios, situation 1 and situation 2, right? Now, operating profit.
We see only a presentation.
Sorry?
We see a presentation only. We can't see any other side.
Now, do you see it?
Yes, sir.
So assume that there are two situations. So your operating profit was 500, right? For two identical companies. And one is levered, the other one is unlevered. So assume that you have borrowed, so some sort of borrowing, if you want, you can assume that entire amount has been borrowed. But we'll assume that your company runs with borrowed funds, corresponding interest is 20. Therefore, net interest expense, we'll use this standard. Actually, this is the net interest expense. We'll use the notation called net finance expense. Assume that that is 20. Here there are no such finance cost, since you have not borrowed. You have not borrowed, you do not have financial assets even. So therefore, your profit for the year, net income, becomes $480, but here 500. Now, when it comes to taxation, right? So impact of taxation, that is what we call tax savings. Tax at we'll say 30%. Okay, I would like to ask a question. What is the minimum tax rate that the recently held G26 Global Summit, recently a particular summit, all G26 countries, industrialized countries, they held a summit where they took up the issues of global climate issues as well, where in addition to the social issues, where they pass a resolution that in the world in the future there should be at least a minimum income tax threshold for companies. Otherwise, companies really take the advantages from the prevailing situation. So bailouts, other benefits, and use of shell companies, transfer of wealth, and all those things at the end, they just transfer losses to one place and run away with the money. So these kind of things are there in the finance world. So now world is now discussing about these issues in a way. In order to be fair, corporation should pay more tax than individual, though we have a different experience. Corporate pay less tax, individuals pay high tax. So did you just notice that needs or come across the tax rate recommended by G26 countries or at that summit? Did you notice it? Did you see that news?
Is it around the 5%?
Huh?
Is it around the 5%?
No, it's not. Actually, it's 15%. 15%. That is the minimum. That means authentically governments are not encouraged to offer tax rate, income tax rate less than 15%. It's going to be unfair. They use these tax rates to transfer wealth here and there and get lots of advantages, finally individuals. So the idea is this. Actually, world is in a way, no matter, actually we have a totally different society where we do not talk about all those things, social justice, environmental issues. So we never talk about our political discourses, academic discourses, even business discussions, and all those things are just demonstrating at a very primitive level. Therefore, all these things are beyond our periphery. It's 15%. Nevertheless, just for your understanding, read about this particular. There was a particular article as well. So
it is starting from 2023, sir. It is starting. That percentage is starting from 2023.
So maybe in the future.
Yeah.
So was it there in the internet? Is it there? Did you find that information? Okay. So maybe, so even though it was approved, it's not that easy. It's not that easy to implement quickly. That could be the reason. Maybe from 2023 onwards would be effective. So this is how world is now cooperating and agreeing to reduce these inequalities. Throughout the world, inequality is expanding. And again, the greediness of financial systems is becoming worse and worse. So such systems do not care about humanity, do not care about social issues, do not care about environmental issues. Did I mention about the TV series called Squid Game last week? Did I mention about that recent TV series? Squid Game. Did I mention about it or not?
No.
Okay. So this is a Korean TV series, comprises of 9 episodes.
Yeah, I saw, sir. I completed to see.
Okay. So did you see all episodes?
Yeah.
So how about others? Yeah. How about others? Yes or no, please?
No, sir.
Yeah, no worries. If not, I'm not going to explain, like I won't just talk about this thing. If we talk about, bring about the things abstract, and how that is connected to the field of finance, it would be useless now, because since you have not watched it, you better see. Maybe it takes time. Therefore, I do not want to force you, but maybe within a couple of weeks time, you better see it. After that, I would like to talk about it. Lots of things are there, especially one who who saw it? What's your name? Veeratunga.
Yeah.
Yeah, Veeratunga. So you can think of even now, bring your attention to that player's room, number one. So you will learn how this player's room change from the beginning to end. It's finance and the greediness, how it is connected, we'll discuss. And all the games, entire setup, structure, ending. So in the recent past, so this is one of the best TV series which took such an important social issue in a kind of vivid manner through that particular game played by kids. Squid Game. It is something like we also when we was like small, we used to play something called batta panino again. So something similar to that. So similar game. But
it's end from that game. It's end from that game.
Yeah. So finally,
game.
so the final game is that is connected. So very interesting, and we can link and relate to finance and how finance systems work in this world, its negative consequences and the areas where we do not see. Therefore, I request everyone to watch it. It takes time, almost 9 hours altogether. I know that when we hear, oh, how come we spend 9 hours? In my case, it was impossible for me to spend 9 hours for a TV series nowadays. But you may not believe, the first episode, once I got the information about this movie, I read something. It's a TV series. I watched only the first episode. Actually, there was a curiosity to continue with the rest, but I could not because there was urgent works in my hand. Reluctantly, I stopped and I managed like to stop. With the second episode, the following day, I watched. Still, there was a kind of temptation to continue, but I managed my feelings and stopped. So you may not believe the third one. Actually, I started somewhere around 12 o'clock because I did some other work. I just wanted to have just break the monotonous to get a little bit freshness. I thought, okay, one episode tonight as well. Likewise, I would finish. You may not believe I could not stop on that particular day. So at the end of the third episode, automatically I felt of seeing until 5 o'clock in the morning. I watch and finish it. Please watch. Okay, that's worth. Right. I'll come to this. Assume tax rate is 30%. Therefore, this is the tax. 144. And here, see, if you look at these two figures now, these two companies had the same profit. Before, talking about net financial expenses. But what happens because of finance expenses, this company was able to reduce its tax liability. So here this company is going to pay 150. This company is paying only 144. So difference is 6. 6 is equivalent to the tax rate of this amount. 30% into this. So this is what we call tax savings. Is that clear? That is a benefit, indirect tax savings. So tax savings, sometimes we use another word as a shield, protection, tax benefits, tax savings, likewise. So that you can argue, if that's the case, net finance expense after tax would be -20 minus 6, therefore 40. Now you can see, because of this advantage, by that amount your net finance expense should be deducted, then your real or effective finance expense would be less than the gross amount. Now you see how the borrowing cost goes down due to tax benefits. So this is the point you need to get. As a result, inherently corporations are benefited by borrowing. They borrow a lot. They are not afraid of borrowing. In a way, it's good. Borrow and expand its business, use that money for the course of production. But unfortunately, it doesn't happen. What happens? They use their capacity to borrow and borrow lots of money and use it for some other purposes. Maybe investment in the finance market, stock market, something like different things are there. Is that clear to you? Is it clear to you the impact of taxation on the interest cost? Hello?
Yes, sir.
Is that clear?
Yes, sir.
Okay. Please tell me whether you just lose the visibility since I move here and there. Anyhow, I have shared the entire screen. Then you must be able to see everything. It's seeing, right? So this is a very important area, how financial leverage affects return on equity. This is another one, operating liability leverage. Another support comes. The first one, this support comes because you can borrow at a fixed rate, then you have a tax advantage. This support is without paying any interest. The tax advantage is already there if it is an expense. Even if it is not an expense, if you have taken some advantages like such as payables, accrual expenses, and all those things are operating liabilities. So what is the benefit of these things? So how long you can keep these things? How big it is? Whether the magnitude of operating liability would have an impact on return on equity. So we need to check. The reason is there are immense opportunities for an entity to deal with financial leverage and operating liability leverage to increase the profitability. So that's the idea. You may come across different scenarios and instances, but when we talk about a competitive entity, or assume that we operate in a competitive environment, right? Your competitive strength really matters. So therefore, it's difficult for you to play with the price or to compromise your quality of the product also to an unnecessary level, because they should be at par. You can do something through your some innovation, process innovation, product innovation, way of organizing things, what we call org way. Lots of things are there, maybe dealing with how you organize the things in an organization, within an organization. However, even whenever you learn something, organizational learning, other entities also will learn the same thing. The idea is it is extremely difficult for an entity to outperform another entity in terms of price increases or cost reduction or bringing new product development. It is extremely difficult. Instead of that, on the other hand, it has enormous opportunities to use its financial leverage in such a manner to increase the return on equity, and the operating liability leverage to increase the equity, and in the level of efficiency that prevails within an organization, what we call org way of organizing things within an organization, within an entity. The difference between return on net operating assets and return on assets, already we discussed about this. If you have any question, please ask. I told you, when we calculate the return on asset, it gives you the aggregate return, whereby pseudo losses may have been set off the pseudo profits gain. There could be lots of unproductive idling assets, but we can't detect the differences. So you take only a single figure of return on assets. Again, for the reformatting purposes, we broadly divide all the assets into two baskets. One are the assets, that is economic resources, over which you have, or the entities has its own control. You can do whatever you want. You can, that's typical for your operations. Therefore, ability of generating future economic benefits or expected return by using operating asset is totally different from return that you would expect from financial assets. If you lend out, you would be guaranteed fixed interest. You can't have or access. You can't have access to extraordinary return. How profit margins, asset turnover, and their composite ratios drive return on net operating assets. Other day, the last week, we calculated, decomposed profitability into a simple way. Remember, what are they? How did we decompose the profitability last week? What are the components of profitability? If you use the numbers given in the financial statements as they are, what are the components that we discussed last week? Yes? Please speak up, otherwise it would be really boring. Because everything is connected to the next step, right? Step by step when we go on. Yeah? What did we discuss last week?
So from the returns on total assets and the profit margin, we arrived asset turnover ratio, and we tallied the amount by multiplying profit margin and asset ratio, asset turnover ratio. The answer will be same to the returns on total assets.
Yeah, return on assets. So yeah, you are right, exactly correct. So that means we simply broke down return on asset into two components. One is the margin, the other one is the asset turnover ratio. So basic idea is given there. Profit margin is something we believe, like we argue that which cannot be easily altered. Thereby, this breakdown will help managers to think of ways of improving the asset utilization efficiency. The same thing will be done by using the reformatted financial statements as well. If you do this thing without having the reformatted, that's also all right. Why? It gives some idea. Everything may not be detected. I mean, even under the second analysis, everything will not be detected. But when you do the same analysis or decomposition of return on assets into margins and efficiencies under reformatted financial statement, that will reveal something extra which was not revealed in the previous one. So therefore, the margin will not be calculated the normal way, but the return on asset is not calculated in the same way, where we take only return on net operating assets on the belief and assumption that net operating assets or the operating assets are the assets which are really in the ordinary course of business. So whereby the total amount of money required to run such a capacity is the net operating asset. Net operating asset. Operating asset is the overall ability. In order to maintain such an ability, what we need is the amount of money embedded in net operating assets. So that's the idea. Then that would be further broken down into different classes of asset turnover ratios by class or maybe type, SBUs. Likewise, we further separate operating assets as much as possible, then calculate the efficiency, which will give you much fairer understanding for sure. How borrowing costs are analyzed is also another learning outcome. How profitability analysis can be used to ask penetrating questions regarding the firm's activities, maybe with respect to certain areas, with respect to certain decisions or future strategies. You must be able to ask how this analysis is going to help us. This is the structure, decomposition structure. Have a look first. Need not to worry about the notations or wordings that we have used here. Automatically, your mind should go back to the DuPont analysis. Have you ever seen a structure like this, a ratio analysis structure like this? DuPont analysis? Yes or no? Hello?
No, sir.
That means so DuPont analysis must have been missed anyway. If you have an accounting background, yes, definitely that area should have been touched. It's all right. We can tackle it. In a way, it's all right. If you do not know, then you are going to learn it fresh. But is it clear for you guys that this structure, if you can ascertain or estimate the numbers, prepare the numbers for each and every component, will it give you some effective decision, useful information for us? It should give you. Why? It is not an aggregate amount. The idea of this decomposition is aggregate amount is divided step by step, referring to certain levels of operations. On the top, at the end of the day, what matters for the owners is not anything else. In a market economy, what do owners want? Profit. What's the limit? No limit. So as much as possible. So therefore, we are deceived with an objective called profit maximization objective or wealth maximization objective. Right. So at the top, first we'll calculate the ROC, the return on equity. How do you calculate? You need not to have many information. You need to have net income, that is the profit after tax, and average equity. Easy, right? Can you guys quickly calculate, do the calculation of ROCE for Melstar Corp and ACL cables? Before continuing the discussion, we better take that number first. Hello. I hope you have the annual reports, right? Have you done the calculations? Is that clear to you? What you are supposed to do? Hello?
Yes, sir.
Okay. So take 5 minutes and do the calculation for both companies. Only the ROCE. Only the ROCE. Okay, then ROCE is there, that is the return on equity. It is broken down into two. On at the top level, we are interested, as I just told you, what matters in an entity when we talk about the profitability is nothing else but the operating assets. What net operating assets? Net operating assets. There is a difference, because be careful, try to understand difference between net operating assets and operating assets. Actually, the total value of the operating assets is the one gives rise to, one depicts or demonstrates the ability of an entity to create value. But in order to maintain that value, you need not to invest that much money because of the operating leverage. That is why we prefer to use return on net operating assets instead of return on operating assets, because if there is any difference, that could be explained from this operating liability leverage. If I go to just tell you with numbers, say total operating assets, say 1,000 operating assets, as the word implies. So now your entity has an operating capacity amounting or worth of 1,000. So that's the simple idea. Agreed? So therefore, it gives you that much. You do not know what the return is, but that is in operation. However, when it comes to investment, you know that you need not to invest the same thing, right? To run the or maintain that amount of assets. If you have operating liabilities, you deduct operating liabilities of 200. Therefore, the amount that you have invested in the business is 800. Simply speaking, your owners or the entity now has been enabled to maintain operations with a capacity of capacity which has a value of 1,000 by investing 800. So therefore, whatever the return that you gain, of course, this is a return of an asset base of 1,000, but in order to get this return, you have to invest only 800. That's the idea. So then better indicator of the profitability is not the profitability divided by 1,000, but by 800. Then it knows. So if there are any differences, that has to be further analyzed, how much benefit that I have taken because of this. This is what we call operating liability leverage. You can recall your knowledge about basic working capital management. You know that current assets and current liabilities. No, under current assets we have inventories and trade receivables. There could be so many others. We'll take receivables and cash. So assume that you want 500, 250 and 150. So this is what you have. This, how do you call this thing? Working capital. Working capital. Actually, this is the total of current assets. Because you need to maintain that much of inventories to facilitate your production process without any disturbance. Then you have to sell your products on credit. You need to extend credit periods. As a result, always there would be an average trade receivables amounting to 250, meaning you have to invest that much money, right? That is what we call working capital requirement. This is the thing, you production, you manufacture thing, you sell, and you need to wait for some times. On average, debtors amount to this much. Therefore, 750. Plus, to make quick payments, day-to-day things and all, you need another cash of 150. So simply speaking, you need to find 900 rupees or 900,000 or whatever million. So to make sure that your day-to-day activities are carried out, that's the idea. That's what we call working capital. But in order to maintain the same working capital, you need not to specifically, distinctively tie up your resources amount into 900,000 if you can take that some operating liabilities, such as, say, simply we'll take trade payables. You buy raw materials on credit, say 300, and do not pay. So on average, throughout the time period, you have that facility. What is the meaning? Meaning is you maintain a working capital base amounting to 900 only by investing 600. Therefore, your return is on 600 and not on 900. The same story is here. By investing 800, you are gaining benefits which are generated from an operating capacity amounting to 1000. So that's the idea. I hope it's clear. If it is not clear, please ask. That is the analytical perspective. Is that clear? Hello? I'm not hearing. Hello? Is that clear or not? Hello?
Clear, sir.
Right. Then we will move on to the second level. Is the top, actually. So second level, in the sense, second layer, it becomes the actually first decomposition. This is the top, then the second decomposition. Then the return on net operating assets is decomposed into return on operating assets. Return on operating assets. If there is any difference, assume that return on net operating asset is 15, return on operating asset is 11, then 4 has come from operating liability leverage. Then we need to identify this. So why do you need to identify this thing? To further investigate, to see the possibilities of manipulating your operating liability leverage. Then we further go down to analyze return on operating assets. Then this is the area, we did this analysis by taking the total assets, not operating assets. Here, with the decomposed reformatted financial statements, in the decomposition, we do that particular analysis with operating assets. Then operating assets efficiency, that is the asset efficiency. Even though we call asset turnover ratio, we take only the operating assets. Here we take only the operating income sales, not the net income. Then this is multiplied by this, will give you return on operating assets. Then the third level Okay, the other side. So this is the return side. The decomposition, further analysis comes through your operations. The other part is the advantage that comes as a result of borrowing. So that is also required to be analyzed. How best you can get, or how best you can improve your return on equity by borrowing. Always, if you can borrow at a rate which is, or the net borrowing cost like after tax rate, which is less than return on net operating asset, it is favorable. What we call, you have a chance of utilizing that money to create value. Your borrowing cost is 5, return on net operating asset is 15, of course. So extra borrowing of 100 will help you to push your profit by 10, because you generate 15 out of that 100, you keep 10, you give 5 as interest. So that's a simple idea. So that is what we call spread. If you have such a difference, spread, return on net operating asset minus net borrowing cost, net borrowing cost. So if the bigger the spread, or whatever the spread that you have, the total impact of the leverage is not the spread, but spread multiplied by financial leverage. That is normally we calculated through debt to equity ratio under normal situation. But here we take another ratio that is called financial leverage. Net financial obligation, it is not only the borrowings minus and whatever financial asset that we hold. So always we go with the logic. So that is the asset base which corresponds to finance net borrowing cost. So therefore you take net financial obligation or net financial liabilities divided by equity. It is what we call financial leverage. Financial leverage, right? Then if you want, you can further decompose the borrowing cost into different sources of borrowings from that bank, this bank, commercial papers, debentures, different types of shares. Likewise, you can analyze them. You know why for certain things purposes we need a weighted average cost of capital. So weighted average cost of capital is a result of all the combination of each and every capital component. There could be some components which will give you unnecessary pressure to push the borrowing cost up. Then we can take a decision to reduce them. So that is the purpose of going ahead with the third level analysis. Third level analysis, if you take different aspects, the analysis is the same. When we say third level breakdown of borrowing cost, borrowing 1, 2, 3, 4, 5, 10, all the analysis is the same. So likewise, hereinafter, all the analysis are the same. Individual asset and the liability turnover, other operating income over sales, expense ratios, different margins of different products. Likewise, you can do all those things. So this is what we call the basic ratio or the profitability decomposition. Any question? Okay, I hope the question will follow later on when we really work out. Now the analysis, if I want, I can say that drivers of ROCE, therefore there are 3: analysis of leverage, analysis of operating profitability, and analysis of net borrowing cost. So this is how these are the things really drive your profitability. Just go back to this return on net operating assets, then analysis of operating assets, financial leverage, and operating leverage. That can go into detail. That process is called decomposition process. Now, first level breakdown. So here the breakdown is clear, but it could be done in different ways. How do you do this? Return on equity? Yes, you can take the comprehensive income, net income, divide by this. Or you can take operating income minus finance expenses and take the equity. So whatever. Or, so this breakdown is important. Return on equity is further explained in this manner. Return on net operating assets, financial leverage into spread. That was the one I explained here on top. If you want to further analyze it, just have a look. This is the return on net operating asset and net operating asset divided by shareholders equity, common shareholders equity, right? We know that when there is a borrowing, which component is big, numerator or denominator? Or in other words, when a company has borrowed money to run its operation, out of these two components, which one will be big? The bigger, net operating assets or shareholders equity? What do you think? I want to hear from everyone.
Net operating assets.
Yeah, net operating assets. Do others agree on that or contradict? How about others? Hello? Yeah, please speak up. Otherwise, this lecturing is really boring. I'm also become a bit fed up of talking because there is no point of just trying to explain things. I can record it and upload it. If you do not engage in the teaching learning process, you can't learn. What do you think? Okay, why do you say that net operating asset is bigger? Why do you think, or did you just guess it or what?
Normally, shareholders' equity is some kind of some percentage of the company asset.
Mm-hmm.
So that asset will definitely more than the shareholders.
Okay. Actually, what entity has are only assets and liability. Assets are the resources. there should be a way of financing assets. Assets are financed. So as far as this entity is concerned, now we have restructured all those assets into net operating assets. So net operating assets are the assets which are in operations, or the money that we have utilized for our investment. In other words, so these should have been financed. Of course, if we have borrowed some money, so the value of net operating asset should be equivalent to equity plus borrowing, net financial obligation. So that is the thing. If net operating asset is 100, if there are no borrowing, so that means common shareholders equity is also say 1,000. If net operating asset is 1,000, and if you have borrowing of 200, of course shareholders equity becomes 800. So the simple answer to this one, net operating asset is equivalent to common shareholders equity plus net financial obligation. If you just recall the reformatting, that is why you understand that this subject cannot be understood simply looking at the slides or reading any other things. We need to discuss and argue and interact. Otherwise, you would either get nothing or very little. Then learning outcomes will not be achieved for sure. Always, even though very simple thing, it links to each other. So that's the point. Why I asked this question? Question was, this understanding links to something what we call equity multiplier. This is what we call equity multiplier, right? Say net operating assets 500, common shareholders equity 300, net financial obligation 200. So that particular ratio for the multiplier becomes 1.66. Okay. The importance of equity multiplier is in the decomposition level, if we come to know that this entities, the impact of borrowing is positive, there is a spread, and we can expand further, maintain volume, and you need to check all those things. And there is an enormous opportunity for this entity to increase this multiplier. How? By borrowing more and more. So if you want expansion, you borrow further. So you borrow another 200, this becomes now 400. If you borrow another 200, what happened? This becomes 700. And what happened to this multiplier? What happened?
Increase. Increase.
Increase, quickly increase. So that is the meaning. It has this multiplier has an ability of multiplying profits if you can maintain such operating capacity. So that is the reason we look at this decomposition, right? So in our class of financial statement analysis, our objective is not to simply calculate the things. Don't expect that. What we want is the interpretation. So these calculation can be done by anyone. Okay. So the impact of this the equity multiplier would be there. Then that will give you the potential equity. From that, you need to deduct that part of leakage, that is nothing but your borrowing cost. So this one is the situation where we have borrowing. So with borrowings, simply disregarding the cost of borrowing, what would be the return? So this much. In other words, assets have generated that much, but you need to set aside the cost or the expense for the borrowing. So that is how the portion for equity holders remain. Okay. Any question? Okay. This operating spread, I already explained. That is the difference between return on net operating assets and the net borrowing cost. Under normal circumstances, this spread looks to be positive, but there could be instances due to some exceptional cases, maybe a situation like COVID pandemic, your operations are highly curtailed, whereas you got to deal with incur lots of fixed costs, or due to any other reasons, maybe due to related party transactions or any other things, your net borrowing cost may be higher than the return on net operating assets. So if that's the case, you are in really, really troublesome situation. So this is the same thing I just explained you. Now, I want you to look at this graph for a while and tell me what you observe. Yeah, I want everyone to speak. Otherwise, I'm not going to explain this slide for you. Take 5 minutes and note down what you observe. Right. Okay. What did you observe? Any observation? Yes, please. No observations. Then no
So,
comments.
so when the ROC gets 0, if there
When?
is the ROC, return on equity, is 0, at the time return on net operating assets equals to financial leverage into spread.
Say it again. When ROC is 0.
Net return on net operating assets equals to financial leverage into spread.
Okay, we'll see, we'll discuss. So how about others? Observations?
So when the spread decreases,
Sorry, say it again.
When the spread decreases, ROC obviously goes down, decreases, but that doesn't indicate the efficiency, because it doesn't. So when it comes to assets, we can tell that relates to efficiency, but related to equity, we can't tell about that, no?
Okay, we'll see. Anything else? So you can just explain any number of observations, so need not to limit to one, but at least everyone should come out with one observation of this graph. How about others? Who just talk, Ilakshi or Madhavi?
It was Madhavi.
Madhavi. Then before you, who spoke? Ilakshi?
Swatika, sir.
Huh?
Swatika.
Okay. Then we just go by the list. Swantika. Then your name. So I like if you can mention your name. This is 5266 FM201. Who is that? Yeah, 2019144. What did you observe? Need not to know anything about concepts. So you are given a graph. You must be able to say something about that graph. Need not to have any conclusory ideas, interpretation. So I just ask you to give me observation. That's enough. Yes. 209144. Do you hear me or not? Yeah.
Yes, sir.
Please.
Yes, sir. Here.
Yeah. What did you see in the graph?
This is a negative relationship between
Negative relationship between what and what?
relationship.
Hmm?
Negative relationship between ROCE and RNO.
Negative relationship between ROC and RN, or return on net operating assets. Okay, no worries. So whatever. Next. Ilakshay. Are you there? Madhavi de Souza. Viratunga.
So when RNOA increase more than ROCE, then spread also decrease, because that spread is mentioned in RNOA minus RNBC. So when the RNOA is increase, mean that spread also increase.
All right. We'll discuss. Anyway, I just have to communicate with you. I'm highly disappointed. Not because that you gave me different answers or like so. If you are not cooperating or interacting in the class, there is no point of having these online lectures. I will talk to MBA office and just release some videos with a brief explanation. Maybe the same thing that I discuss in 3 hours time. Actually, to talk about in terms of learning contents, I need not to take 3 hours time. In half an hour time, I can just mention the things. Then you have to manage it with that one. I do not assure that there would be learning, but you can listen to some videos if you like. If not, I don't know. But this is adult learning because you are not infants, right? I just told, because feel free to talk. What I ask is not the right answer. I asked clearly, so what you observed? No matter whether your observation, say whatever you observed, that is your observation. Even if you do not know anything about finance, anything about accounting, financial statement analysis, even grade 5 student or whoever who knows, maybe grade 10, understand a graph, can say that I observe that there are, so x-axis is this difference between ROC and RNO. Then sorry, y-axis, n-axis, x-axis, again you could have highlighted, I had a confusion whether it is a financial leverage or ROCE. Some confusion is also there in the graph. So that is how you first understand things. If you do not read and understand, then how do you learn? You can't. You should ask the question, so what does the x-axis represent really? Without knowing it, just come to conclusion. Then you can say that even simple observation, even a small kid who can speak can say that, oh, I do not see, I observe that there are colorful lines. That's it, don't you? So they are the observations. Then you see a spread, something called spread has been given there from -2 to +6. Those are the ordinary or the observation that layman can come out with. Then the observation that are expected from someone who has some idea of finance, accounting, or not finance and accounting, basic education, can say without having any knowledge about accounting and finance. First, the observer has to clear off this. What does the x-axis represent? Whether it is ROCE or financial leverage. Actually, it has not been specified there. It is really financial leverage. ROC is these lines, actually these colorful lines. Actually, this should have come on top. ROC is equivalent. RON. Now already I explained you. With that knowledge, you could have predicted that and just carefully observed. Anyway, don't worry. ROC is the title here. So these lines are ROCE lines. The impact on ROCE. Impact on RO. So what would happen to ROCE? Then this, when it comes to this light blue color line, the impact of something on ROCE is high compared to other lines. And when it comes to dark blue line, even here these things are above green and above impact is positive, here impact is negative. Nevertheless, so when it goes up, the impact increases in a positive manner. Now further you can say this particular line with the specific line, some some complexities are there in this particular graph compared to a traditional graph. The dark blue line is the line when the spread is -2. The second one is the spread when the spread is -1. Spread is 0, meaning there is no difference between R in return on net operating assets and net borrowing cost. Spread means the difference between return on net operating asset and the borrowing cost. If there is no difference, spread is 0. If the borrowing cost is greater than the return on net operating assets, your spread always is negative. So positive spreads are situation where net borrowing return on net operating asset is greater than net borrowing cost. So these are the first observation. Then interpretation, the conclusions or explanation about this particular graph is your y-axis shows the difference, not ROC. Difference between ROC and return on net operating assets. It is not the spread. If you just recall previous, you see, ROCE comprises of return on net operating asset and the impact of leverage. So therefore, it is clear, it implies that ROC, so return on net operating asset is less than ROCE when there is a positive impact of leverage. When ROCE is 20, return on net operating asset is 16, this component should be 4. That's it. Once you calculate these two, you can conclude that there is an impact for coming from leverage amounting to 4%. That's it. So that is the analytical conclusion. If you are given some ratios, ROCE 20, return on net operating asset 16, then you can straight away say that yes, so borrowing has increased your ROC by 4%. Difference. If there is no difference, that means we assume zero situation. So there is no difference. At the very beginning. Sorry. Yeah. One minute. Arrow is not going, right? Oh. Something. What is it? Anyway, now you can see. So if you look at the 0 point, the y-axis, that means there is no difference between ROC and RNO. That means spread, the impact of financial leverage is 0, no difference. Here RNOA is equivalent to ROCE, meaning the other component is 0. If the other component is 0, of course, spread is 0. So by starting from that point, we introduce different spreads. The green line is a situation exactly equivalent to a spread of 0. That means 0 spread situation under different scenarios. What are the different scenarios? Different scenarios are we increase the financial leverage. Here you see, even though this entire component is 0, now we made this to be 0. That is the difference between this RNAO and net borrowing cost spread 0. We keep increasing financial leverage. What happens? No impact. If there is no difference between these two components, if the spread is 0, that means there is no point of increasing your leverage. Even if you borrow that much heavily 2 times or no borrowing 1, 1.2, so there is no point. This is what the Miller and Modigliani's theory explains on certain assumptions. This is what you should experiment and you should question. So he says that normally things can be borrowed. I mean, any amount can be borrowed at the prevailing market rate. Any amount can be lent. In the financial markets operate in highly efficient manner. If that is the case, there will not be impact on ROC or the value creation of a company, irrespective of the fact that whether you have borrowed or not. More or less the similar situation. When the spread becomes 0, no point of borrowing. Or having borrowing, it doesn't make any difference. But look at the others. I'll just explain only 1 or 2. Just go to this light blue line. Spread is 6, positive 6. That is the highest one. The impact on ROCE is very high when you increase leverage. Even if you do not increase the leverage, that is observation. If you do not increase the leverage, even though the spread is positive 6, you can't get an advantage. Why? Here there is a difference. That means ROCE 20, return on net operating asset is say 14. Then the difference is, sorry, no, not that. This one, spread is this one, right? Our return on net operating asset is 16, net borrowing cost is 10. Then difference is 6. But if this is 0, what happens? No matter 6 into 0 becomes 0. So therefore, automatically ROCE is equivalent to return on net operating asset. That's it. That is what it says and show you automatically. Then there will not be any difference, even though there is a spread. Right? Did you get it? Even though there is a spread, there can't be any difference between ROC and return on net operating asset. So that means even though you had an opportunity of increasing your return, you have not utilized it. That is a signal, so additional information for managers. But if you keep on increasing your leverage compared to other lines, and what is shown by other lines, this light blue line show you that greater the financial leverage, greater the impact on ROCE. That difference increases. Just see, if you increase the leverage to 0.25, automatically difference become 2%. Two little bit different. So how do you get it? 0.25 into this 6 into 0.25 means 1.5. So therefore it increases by 1.5. If it comes to leverage of 1, when the spread is 6, 1 into 6, it therefore the difference between these ROC and return on net operating asset should be 6. That is why it is somewhere exactly here. You can check. When the financial leverage is 1, automatically difference becomes 6. When the financial leverage is 2, what would be the difference then? With respect to this light blue line? Yes? Any idea? What would be the difference between ROC and RNOA when the financial leverage is 2 with regard to the spread of 6?
Well,
yeah, 12. That is why it is not seen in the graph. You got the point, right? The difference always is explained by the multiplication of spread and financial leverage. So therefore, the thing that you need to keep in mind is that the impact on ROCE is resulted not only by one component, but by a combination of two, combined impact of spread and leverage. Then you've got to be very careful. By the same way, when the spread starts becoming minus, again, impact would be multiple in the same way. If it is spread is -2, if you go for financial leverage of 2, 2 into 2 means 4. Therefore, difference is 4. That means even though your assets, operating assets, generate something of which 4% has to be sacrificed because of your wrong financial management. Discipline. Any question from that? Is that clear? Yeah, if you do not understand anything, please ask before proceeding. These are some examples given to demonstrate how these things have worked. So relatively old numbers, now we first go through this, and you guys can work out based on Mel-Starkov and ACL cables. Net operating asset, net financial obligation, and all those things are there. And of course, the equity multiplier is a bit high, and operating income is this much, net financial expense is this much, comprehensive income, that is the net income, finally is 1,251. Financial leverage here is 1.5. 0.67. Can you check whether that is correct quickly? Financial leverage. Is that correct? Work out and see whether you get the same number or not.
Yes, sir, getting 1.67.
So did you get it?
Yes, sir.
How did you get it? What did you do?
So here we know the ROCE,
Mhm.
20.5,
Huh.
and also we know the return on net operating asset as well, sir, and also we know the spread.
ROC is there. From where did you get return on net operating assets?
The 12.5 is also mentioned here.
Yeah, it has been just given, but how do you calculate it? Okay, just explain me. ROC is there, then you use return on net operating asset. Then there is a difference, right?
Yes, sir.
How much is the difference?
Mm,
How did you reach to that value? That is what I want. Otherwise, you can reach that value. Okay, that is given there down. No, I want you to calculate it and get it. So you calculate it by taking ROCE, then return on net operating assets, then
I have taken the below value, sir. We have to check in the. Do we have to check the basic information given
yeah, that is
above?
the below value. So I mean, if you have just taken it from the value given down, it's not a calculation. It is there. Even no point of just taking the down value there. So value is already given. We need to check whether it is correct or not with the given information. Yeah, how about others? Just yeah, give a try again. If you do not calculate, you can't understand. Yes. Yes. Don't you find any ways of just connecting to these numbers?
Is this financial leverage?
Hmm?
You mean the financial leverage values?
So, yeah, I want you to calculate all these things and understand first. So we'll go one by one. If you calculate financial leverage, we'll move on to the next one. So did you get this number? If so, how did you calculate it? Or how do you get this value?
Financial leverage I get from operation income divided by net operation asset.
Then do you get this number?
Yeah, it's 1.667.
Are you sure?
Yeah, 6 is mine.
No, how come? So operating income is 1,575 divided by what?
So NFO divided in CSE.
Yeah, financial. Yeah, so that is the one. Financial leverage is so the amount that you have borrowed, net amount.
7,860 divided by 4,000.
No, not 12,000. 12,000 is the total assets, net operating assets.
So
Your
7,800.
net borrowing is 7,000. So divided by 4,000. So very simple. Just see now the problem that you guys are going to face if you do not work or give a try to work it out. You look at the number. If I just read out financial leverage is this is multiplied by this, so nothing goes into your mind. You do not understand how and why these things are taken. It's not a big deal. So that is now you should understand the importance of engaging and working. Otherwise, you can't learn, to be honest, this subject. Don't blame me at the time of examination. Right? That is why I just gave you the opportunity and all the time and encourage you to ask questions. You do not know, so just you have to tell me, because all the things I am just on the belief that I am just explaining you understand. You do not look at the numbers, do not interact, do not do calculations. Then how do we learn? We can't. Very simple thing. It is not a big deal. Right? Please understand, because I don't want to blame or just make you guys feel bad, but I have to straight away communicate the feeling that I have because you are adults. Yeah, net financial obligation is the borrowing, because this now we deal with reformatted financial statement. So therefore equity is there, debt is there. This is the level of borrowing in terms of financial leverage, 1.67. If you want, you can calculate equity multiplier. Can you guys calculate the equity? So it has nothing to do with here, just to understand the concept. What is the equity multiplier here? Or how do you calculate it? Possible?
Yes, sir, we have to get the net operating asset, and that should be divided by CSC.
Okay. You see now relatively high multiplier is there. In other words, it implies and tells us that the multiplier is high, so that if there is a positive spread, there is a great chance for this company to increase its return on equity as a result of this borrowing. Even further borrowing could be recommended. Okay, ROCE 26.5. How do you get it?
Net operating income divided by CSE.
Yeah. What is the net operating income here?
CI.
CI, that is a comprehensive income or net income. So it comes to 26.5. Good. So straight away, these two things can be calculated. Return on assets, operating assets. Return on operating assets. How do you calculate? You cannot calculate it. It should be return on net operating assets. Calculate the return on net operating assets. It should be, I need to check it. Calculate the return on net operating assets. How do you calculate it?
Operating income
Divided by net
divided by
operating
net
assets.
operating assets.
What is the answer? Right. 'So this machine is also giving some problems.
$12.52.
12.5, yes. So therefore here there is a mistake. It is return on, maybe when I revise this, let me correct it. 12.5. Okay, just check net borrowing cost. 4.1%. Because something wrong with this machine. Yeah, calculate the other one. NBC, do you get this value or not?
What is 4.11?
How did you get it?
NFC divided by NF4.
Sorry, net
Net financial income divided by net
finance expense.
expense divided by net financial obligation.
Obligation. Okay. Now, having all those numbers, you can now interpret. So the calculation that you did here, I think cannot stop for the time being. 26.5 is ROC. Return on net operating asset is 12.5. Leverage is 1.7. And spread is, how much is the spread? How much is the spread? Huh?
8.4.
8.4. Yes, that is a big spread. You see, that is why you have big impact of this financial leverage on ROC. You can easily reconcile and see in a situation or in a company where your operating asset, net operating assets are capable of generating simply somewhere 12.5, whereas your owners, equity holders, get 26.5. The difference of 14% is, in other words, the impact of financial leverage. Impact of financial leverage is 14%. It can be calculated by deducting 12.5% from 26.5, or you can multiply it 1.67 by 8.4. Just check whether you get it. Why I can't use this cursor? Maybe because even this cannot be stopped. Something wrong. I do not know why I can't. Even no alteration here. Cursor is not moving. Maybe I block this. All right. Now it would be possible. Yeah. So 8.4% into 1.67. So it comes to, yeah, 14 point. So rounding up errors must be there. Roughly 14%. So that is how you get that one. Okay. Then what if return on net operating asset fell to 2%? So here return on net operating asset is 12%. If it falls to 2%, what would happen? Then there will be a negative spread. Then ROCE, can you work it out? ROCE, what if net return on net operating fell to 2%? Instead of 12, now you can reconcile, not with these numbers, because with these numbers you can't. So these numbers fit to this given situation. If return on net operating asset fell to 2%, what is the spread? The spread becomes, provided that the rest is the same, spread become net borrowing cost is 4.1, return on net operating asset is 2, therefore 2.1 is a negative spread. You can see here in this. So 2.1 into 1.6 will be the net impact. So can someone sorry. You better do the calculation and see, realize it by yourself. Then the spread become minus 2.1. Minus 2.1, 1.67. So therefore, the impact of leverage would be minus this much. Minus this much. So therefore, if this is what we call impact of leverage. If the impact of leverage is this much, your return on net operating asset is 2. Therefore, return on equity will become this plus this. This is 1.57. So this is what is shown there. When it is formatted like that, it should be like this. This is the answer. I think when the formulas were just drag here and there. So this is the net impact. Automatically, all of a sudden, what happens in the previous example, when the spread was positive, whereas a return on net operating asset was 12.5, ROC was significantly high. It has been pushed up by additional 14%, whereas the company experienced a negative spread. ROCE had the same repercussion in the negative way. ROCE is well below return on net operating asset. In the previous case, it's very high, greater than the return on net operating asset. Now ROC becomes even negative because of negative spread. So this is for Microsoft operation. Then I'll explain you the situation. Need not to do the calculation. You better do the calculation later on. The return on net operating asset is 48. ROC is 15. Now you can understand the problem. The benefits return to the shareholders is 15%, whereas Microsoft in 2000 was able to generate high amount of return on net operating assets. What was the reason? Actually, by that time, Microsoft was experiencing huge negative spread, mainly due to Microsoft lended lots of its excess cash to related parties at no cost or zero cost, and sometimes some financial assets. As a result, those returns on financial assets was less. As a result, company experienced negative leverage. Negative spread. So that is the reason why ROC was highly impaired in a situation where the company had an ability of generating $48 for $100 worth assets. Even the leverage was just 0.74%. Then what if Microsoft paid a special dividend? By that time, Microsoft disposed most of financial assets and paid a $33 billion dividend and restructured its balance sheet in the following year. Then it improved its ROCE to 38%. Right? So it had a negative financial leverage that was reduced. Actually, here the problem was negative financial leverage. That was the reason, not the spread. Spread was high, positive, but the financial leverage was negative because the company had lent, not borrowed. They did not earn. So therefore, company reduced its lending to a great amount, whereby ROCE was improved. Okay, before moving on to this operating liability leverage, I want you to do the calculations on these calculations for Mel-Starkov and ACL. With that calculation, we can stop for today. The rest we will discuss. Then you have more time to go through all those things. So I'll just give you 5 or 10 minutes. Is that clear what you have to do? Already you have reformatted financial statements of Mel-Starkov, and if you want, I can show you the numbers for ACL cables. Some numbers are there for ACL cables. Just do the calculation quickly. Yeah, I delete all those things. These are ACL cables. 2021 operating income, net income, and what else do you want? Net finance expense. This is net finance cost. If you want, I can show it here. You need to do a little calculation on net. Okay, first, so you better take ACL cable as a homework. Do the calculation for Mel-Starkov. Mel-Starkov financial statements are reformatted financial statements are with you. Yeah, we have the reformatted one because you did it. Reformatted income statement is there. Reformatted balance sheet is there. Cash flow, everything is there. Leverage. Now you can do the calculations quickly. What are you supposed to do? You're supposed to do calculate ROCE, return on net operating assets, financial leverage, and spread in the reconciliation. So when you add all these things, this plus, so need to reconcile it with ROCE. Take 10 minutes and do it. Any question on that?